Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Isotope and Radiation Corporation Annual Report. China Isotope and Radiation Corporation offers a diverse range of businesses and services across various sectors. In the pharmaceuticals segment, the company develops, manufactures, and sells diagnostic and therapeutic radiopharmaceuticals for medical applications. In addition to pharmaceuticals, the corporation provides radioactive source products and related technical services for both medical and industrial use. The irradiation segment offers sterilization services for manufacturers of medical devices, food, traditional Chinese medicine, and cosmetics, as well as EPC services for gamma-ray irradiation facilities. The company also sells nuclear medical equipment and provides maintenance services through its radiation therapy equipment and related services segment. Furthermore, it offers independent clinical laboratory services for nuclear technology industry applications and medical product applications. Other businesses provided by the corporation include the sale of radioactive sources, medical nuclides, imported radiopharmaceuticals, nuclear instruments and devices, medical equipment, and other products. The company also provides irradiation service for sterilization and researches, develops, produces, and sells irradiation-modified materials. China Isotope and Radiation Corporation maintains a market capitalization of $7 billion, broadly in line with the industry peer group. China Isotope and Radiation Corporation trades at a lower price-to-earnings ratio of 14 times and a lower price-to-book ratio of 1.17 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 48% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 2.04%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in a company can significantly impact its financial performance. On one hand, several factors contribute to revenue growth. The company's increased exports to dozens of countries and regions have been a major driver of growth. Breakthroughs in multiple international businesses have also contributed to the rise in revenue. Additionally, the signing of new irradiation stations in Peru and Bangladesh has opened up new markets for the company. Furthermore, the registration certificates for breath diagnostic products in several countries have enabled the company to expand its product offerings. On the other hand, there are several factors that contribute to revenue decline. The delay in centralized procurement of Class, a large-scale medical equipment, has resulted in a decrease in revenue. Additionally, the decrease in revenue from nuclear medicine equipment and related services has also had a negative impact on the company's financial performance. Furthermore, additional tax and late payment penalties paid by Zhang Headway have added to the decline in revenue. In conclusion, the primary drivers of revenue growth or decline are complex and multifaceted. While increased exports, breakthroughs in international businesses, and new market entries have contributed to revenue growth, delays in procurement, decrease in nuclear medicine equipment revenue, and additional tax penalties have led to a decline in revenue. The company has been generating positive operating cash flow since 2021, indicating a stable financial position. The data shows a steady increase in operating cash flow each year, with significant growth from 2021 to 2022 and a slight plateau from 2023 onwards. This trend suggests that the company's operations are becoming more efficient and profitable over time. The company's debt level and interest expenses have undergone significant changes. An increase in total bank loans from RMB 1,682.43 million to RMB 1,840.82 million indicates a rise in the company's borrowing. Furthermore, the introduction of corporate bond debt as a new component adds to the overall debt level. Interest expenses have also seen a substantial increase, rising by 47% from RMB 38,294 to RMB 71,014. This growth is attributed to various factors, including a 14% rise in interest on bank loans and a significant 439% surge in interest on corporate bonds. Additionally, the company has incurred factoring costs on trade receivables as a new expense, contributing to the overall increase in interest expenses. The changes in debt level and interest expenses suggest that the company is taking on more financial obligations, which may have implications for its future cash flow and profitability. The performance of various segments and regions in the industry has been mixed. On a positive note, radiation therapy has shown significant growth, with an increase of plus 3.8% in 2025 compared to 2024. Irradiation services businesses have also performed well, with a notable rise of plus 14.9% in 2025 versus 2024, and a year-on-year increase of plus 3.2%. The domestic market for irradiation services has been another strong performer. In addition, the South Asia region has shown promise, particularly with the BINA Irradiation Center project in Dhaka, Bangladesh. Radioactive source products have also seen growth. On the other hand, some segments and regions have struggled. Pharmaceuticals products businesses have experienced a decline of minus 12.6% in 2025 compared to 2024. Nuclear medical equipment and related services have faced significant challenges, with a year-on-year decrease of minus 50.8%. The nuclear medicine sector has also underperformed. Other regions that require attention are North Africa, which needs to focus on building core competitiveness, and South America, where efforts should be directed towards driving large-scale export of core products. Management is emphasizing a strategic shift towards nuclear healthcare and irradiation applications, with a focus on research, development, manufacturing, and sale of nuclides and radiopharmaceuticals. The company aims to strengthen collaboration with national-level academic societies to promote outreach at the grassroots level. To achieve this vision, management has launched several initiatives, including a special action project to enhance targeted therapy and increase recognition of nuclear medicine in treatment. Additionally, the company is expanding its control over the industrial chain from raw materials to end products, establishing a complete industrial chain for carbon-14 isotope production, and achieving bulk supply of carrier-free lutetium-177 chloride solution. Management also emphasizes the importance of industrialization and globalization, aiming to transform into a top-notch international organization. This includes implementing an M and a strategy to strengthen core capabilities and expand applications, as well as promoting open new economic growth points and enhancing efficiency. However, management acknowledges that expansion into new regions may be affected by the global economic slowdown. To mitigate this risk, the company is improving its sales model and sales policy to increase revenue, strengthening cost control measures to improve quality and efficiency, and investing in research and development to drive growth in imaging diagnostic and therapeutic radiopharmaceuticals. Furthermore, management is actively exploring investment opportunities both within and outside of China to diversify its source of income. Overall, the company's strategy focuses on driving growth through innovation, expansion, and strategic partnerships, while navigating potential challenges posed by global economic trends. The company has made several strategic acquisitions and divestitures to expand its business operations. In terms of acquisitions, the company has acquired significant equity interests in various pharmaceutical companies. Notably, it holds a 27.7778% stake in Hefei Atomic Gaotong Pharmaceutical Co., Ltd., and Sichuan Atomic Gaotong Pharmaceutical Co., Ltd., as well as a 31.3688% interest in Nanning HTA Pharmaceutical Co., Ltd. Additionally, the company has acquired a 50% equity interest in Qingdao HTA Pharmaceutical Co., Ltd. On the other hand, the company has also made divestitures to streamline its operations and focus on core businesses. Specifically, it has sold an 11% stake in Hubei Zhongsun Medical Supplies Industry Co., Ltd. These transactions demonstrate the company's efforts to adapt to changing market conditions and optimize its portfolio of investments. The company's financial performance is reflected in its dividend payments. According to the provided information, the company has indeed paid dividends. Specifically, it is mentioned that the final dividend of the previous year was RMB 30.9 cents per share and was approved and paid. This indicates a clear commitment to returning value to shareholders through dividend payments. However, there is no mention or indication of share buybacks in the provided text. The focus remains on the company's dividend policy and its implementation over the years. Concerns about inventory buildup or supply chain disruption exist. There are valid concerns regarding potential supply chain disruptions and inventory buildup in the radiopharmaceutical industry. The manufacturing and research bases for imaging diagnostic and therapeutic radiopharmaceuticals have reached maximum capacity as of 2025, indicating a possible bottleneck in production. This limited capacity could lead to supply chain issues if demand continues to rise. Additionally, while there has been a decrease in inventory costs from RMB 3,687,920 in 2024 to RMB 3,265,383 in 2025, this reduction may not necessarily indicate a decrease in inventory levels. The note mentions that staff costs and depreciation/amortization expenses are included in this decrease, suggesting that the actual inventory buildup might still be a concern. That concludes the financial summary for China Isotope and Radiation Corporation. Feel free to comment below, and I will be happy to answer them when possible.